Welcome to Investing Gurukul. In our last video about Apollo Hospitals, we recommended this stock, which was a couple of 3 weeks back when they announced their results. The results were on par with the expectations. Now, a lot of brokerage reports have come up with a target price, which is above 8,000 rupees. So, we reiterate our buy call. This is basically a follow-up video for our recommendation of buying Apollo hospitals. Let's see why it is still a very good opportunity to purchase this stock. So, as discussed earlier, the estimates were 54% profit growth, 14% sales growth. The company delivered 54% profit growth and 13% sales growth. QOQ, 1% sales growth and 9% profit growth. Overall results met expectations, which is really good. This, if you look at the whole financial year of FY25, a 14% increase in sales, 61% increase in profit, and a 26% increase in EBITDA. And they also have a margin of around 14%. Now let's look at different brokerage houses and what they have been saying. So whatever we said, it's the same thing they have mentioned with a target price that is more or less similar to what we said. So basically, we have given this recommendation ahead of I think now that there is FOMO, there is a lot of report that is coming out saying buy call, the stock may continue to go up. Let's look at the report of Motilal Oswal in detail. So they are recommending based on the Q4 review. So improved gross merchandise value and adding new beds is basically improving the overall outlook. So Motilal Oswal is reiterating a buy call on Apollo Hospitals after FY25 ending on a strong note and also after Q4 results meeting expectations. So they do not have any plans for Apollo 24 bar 7 to tie up with quick commerce. They themselves do it. And then a new business segment like insurance is coming up. So basically, overall, this is the story. So this is not just a hospital play. So this has become a proper platform play. So they have hospitals, they have insurance, they have online pharmacy, offline pharmacy, they have diagnostics. So they are an end-to-end stack when it comes to hospitals and medicine. So that is one of the reasons why the company can keep growing really well and the company can continue to improve their margins in the next few years. So if you look at the GMV, it is at 8 billion and 80% is coming from RS medicines and rest from FMCG and health essentials. So they are planning to open new hospitals in Pune, Kolkata and Sarjapur, which is again going to increase their top line. So there were some issues because of geopolitical tension in Bangladesh. So they expect more patients to come from Bangladesh in the near term as this issue is getting resolved. So they keep adding 600 stores every year when it comes to the offline pharma. So they added around 550 plus in FY25. So they're doing really well, but the pharma division is currently not profitable. So whenever they continue the expansion and capture market share, they'll start focusing on profits. So that is when their margins can go up in the next 2 years, sometime probably after 12 months or 18 months. So the diagnostic business, if you look at it, it has slowed down because they have rebranded their strategy, moving away from this franchisee business. So the revenue growth can happen in the next couple of years. So in terms of revenues, right? So 50% sale is coming from hospital business and 43% is coming from Apollo 24 bar 7 and pharmacy and diagnostics is 7% of sales. So hospital EBITDA grew 16% YOY and the revenue, average revenue per operating bed grew 7%. So occupancy is 67%. So overall, the hospital segment is growing really well. So if you look at the healthcare, uh, The EBITDA has come down, as I mentioned earlier. They are not profitable. The EBITDA has come down to 363 from 566 million. So, whereas GMV grew 11%. So, they are operating a total of 2626 stores. 596 stores were added in the last financial year. So, here revenue grew 11% in diagnostics, primary care grew 12%, 9%. So, so here we can expect more growth in AHLL and more profitably in Healthco in the next financial year. So, let's look at their opportunities in terms of expanding in Pan India. So if you look at it, so these are the most important points. So let me highlight it. See, this is what they are saying. So a 15% sales growth CAGR in the hospital segment is expected in the next 2 years from FY25 to FY27. So in this financial year, as we mentioned, 13% growth, they have mentioned the same things. So in the next 3 to 4 years, they are planning to add another 3,577 beds for a total capex outlay of 81 billion. So of which 20 billion has already been incurred. So the primary point is this: the there is a 15% growth expected. So if you look at the healthco, offline pharmacy grew 16% this year. They added 596 crore this year. So if you look at it, let's look at the growth rate in this. So they're expecting an 18% CAGR in this space. So in Healthco, they are expecting an 18% CAGR to reach 123.5 billion by FY27, which is again very healthy. In terms of AHLL, the diagnostics, primary and secondary, they are expecting a 12% CAGR. So 15, 18, 12, all these are some real good numbers. So that is why Motilal Oswal is continuously recommending a buy rating on this, which we discussed and told you a lot earlier. So based on 30x EV to EBITDA for the hospital business, 15x for pharmacy and 23x for HLL, they are coming up with a target price of 8,050, 8050 is a target price. So currently, yesterday it was at 7,200 on Monday, and on Tuesday it fell by 100 rupees. So a cool 15% return is possible from current levels, provided the market remains stable. In case if there is a nifty crash or if the market falls 5% or 10%, then the stock can fall and go down to 6,000 rupees, which can again be a good price to enter. So the valuations are expensive. The company is expected to do well over the next few quarters and the next few years as well. So the target price is intact, but it remains expensive. You can probably wait for a correction, or in case if Nifty falls, in case if you purchase now, you might be in with some unrealized losses, and you have to wait for some time to get to the target of 8,000. So overall, there are three reasons. One is addition of new beds, increasing revenues, improvement in productivity in existing facilities, and loss reduction in pharma division, and then revival in revenue and growth as well as profitability in the diagnostics division. So this is the recommendation coming in from Motilal Oswal. So let's look at others as well. So, so if you look at Prabhudas Leeladhar, PL Capital, they have also given a by recommendation with the target price of 8,100 rupees. So they are saying inline quarter, they have guided stable operating margins. So they've made a small change in their estimates. So from 250490, the estimates have come down a little, whereas for FY27, the estimates have gone up. So overall, the target price of 8,100 is intact. Consensus share price target is 7,912. which is like a 13 to 15% upside from current levels, which is definitely an attractive opportunity. So this video is for educational purpose. So do your own due diligence before investing your hard-earned money in stocks. The company is fundamentally strong, but valuations are a little expensive. As long as the company keeps growing really well in the next few quarters, it can do well. Mm. So did you like this follow-up video on Apollo hospitals? So in case if you like it, please like our video, share this with your friends, subscribe to our channel. So stay tuned for our next video. So if you have any questions, you can post it as a comment. You can also send it to our email, which is investinggurukul@gmail.com. Whatever questions you have, you can send it. We'll help you to build wealth. So let's grow together and build our wealth together and become financially independent. Thank you. Keep watching the space for more useful videos that can help you to build wealth and improve your portfolio. Thank you.